there. Welcome to the REI RockStar podcast, episode number 2. Mike, you there?
I'm here.
Do you like Mike or Michael?
Doesn't matter. Mike's fine.
You answer to anything, right?
Yes. I'm easy.
So check it out. This is kind of impromptu, but we were talking about what's going to happen in 2019. All the market forces are coming together, and we were talking about what we think the direction of the real estate market in general is going to go, and then kind of specifically St. Louis. And I thought it'd be good to record this conversation and get this out to the masses because you had some pretty good insight as to what you think is going to happen. And so before we get to that, let's introduce you. Who are you? What do you do? And how many cowboy hats do you own?
All right, easy. I own one cowboy hat, but I bought it back in 1987, so it's old and I don't wear it very often. But my name's Mike Hoffman. I'm a lawyer here in Dallas, Texas. I've been a lawyer almost 25 years. And 10 years ago, I got into the hard money lending business, started a company called Longhorn Investments, and we make loans to people that want to buy real estate for investment purposes. And we've been doing it for 10 years now. I'm in 5 different states: Texas, Missouri, Indiana, North Carolina, and Tennessee. And we've done about 3,000 loans. And so I went from a guy that really didn't know much about real estate. I was practicing law, not even in real estate law, to a guy that my whole life now revolves around loans and real estate. So it's been a great, fun ride.
You have what's the best barbecue place in Dallas? I can't think of the name.
So, well, you're thinking of Franklin's Barbecue in Austin, probably, because that's the one that gets all the pub. That's famous. Yeah. But listen, the 2 best places in Dallas, I think, are Cadillac BBQ, and Pecan Lodge. But those places are like Franklin's in that you want to go eat there, it's an hour wait. You got to get down there. If you want to eat lunch at 12, you got to get there an hour ahead of time and stand in line. Yep. But it's worth it. It's really, really good.
So I got skills behind the grill, but I don't think I've got enough skills to open up a whole restaurant. But there's a place here that I think has got there's a couple of really good places in town in St. Louis, but one particular place, that I like is Sharpshooters. It's a shooting range and a barbecue joint all wrapped into one. It's pretty cool.
That's cool. So no, Nick, I think you could do the barbecue place. Listen, Cadillac BBQ. Yeah. The guy was into, when hazmat has to come out because there's been a chemical spill or something bad happening. Mm-hmm. This guy owned the hazmat company, and the way he kept guys on site, because they had to work 24/7 to get the stuff cleaned up, is he would cook barbecue. So then he sells his company. And decides to open the barbecue place. He's only open on Thursday and Fridays. That's it. Thursday and Friday at 11 o'clock until the barbecue runs out. So look, I think you could do your real estate stuff on the, most of the time, and a little barbecue on the side, 1 to 2 days a week.
I love it.
You got to think about it.
You put a bug in my head. Maybe that's maybe I'm going to change my whole 2019 goals and my whole 2019 outlook. I'm not doing that just yet. Maybe. Anyway, so yeah, you do tons of loans, you do tons of real estate. Yeah. And I know that sometimes when I run into a situation or a weird whatever, I give you a call and you got some pretty good insight. And that just happened. We were talking about something and we started talking about what we think was going to happen in 2019 in general. And you had some pretty interesting insights on it. You think the market's going to slide back a little bit. Talk about that. What are your thoughts?
So listen, and I've been saying this for a little while now, but I think, and maybe not right away, and obviously every market's a little different, right? But mm-hmm. I think the market is starting to pull back a little bit. Certainly, I know in the markets I'm in, I'm seeing a flattening of the market. Prices are not continuing to go up. Prices are kind of flattening out. And I've been saying that I thought that was going to happen for a while. And the reason is that the basic reason is home prices, along with rental prices, have been going up so much they are exceeding people's incomes. Mm-hmm. People's incomes are not keeping up with the prices of rent or the prices of houses. You combine that with the fact that interest rates are starting to tick up, your dollar does not stretch as far as it used to, and people are not going to be as interested in selling their house and transitioning to the next level of house. So you're going to see there's not going to be as many houses on the market. People are not as interested in going and getting a new house because, listen, your old mortgage rates from 5-6 years ago, you ain't gonna see those again. You know, that dollar stretched really far when you had, 2.7, 3.7, 3.5, something like that. Interest rates now are ticking up, and I don't think it's going to stop. I think the interest rates have to keep going up. The Fed, even though our president might not want them to, I think the Fed has to keep raising the interest rates, because if we do hit a recession at the end of 2019 or early 2020, that's the tool the Fed has to bring the economy back, is to lower the interest rates. Well, if we don't raise them, you can't lower them. So all this being said right now, I think there's going to be a flattening out. I think you're going to see foreclosures start ticking up. I think you're going to see people a little more desperate selling their house. Prices are going to drop a little. Now, it depends on your price point too, right? Obviously, all price points aren't created equal. Starter homes, $150,000 and less, I still think those will be moving. They'll be going okay. There's still good loan programs out there. But when you get into the $300,000 to $600,000, depending on where you are, I certainly know in Dallas, stuff over $400,000, these places are sitting on the market for a while.
Mm-hmm.
So
and let's be clear, we're not talking doomsday scenario kind of stuff like we saw from 2010. We're just seeing kind of flattening out is what you're kind of loosely predicting.
Yeah. It's nothing. Look, obviously, if something catastrophic happens, but no, I do not see anything remotely close to that. I just think that you're going to have to, if you want to be a real estate investor, you're going to have to work a little harder, and you probably had to work a little harder in the last year or so, but it's going to have to keep working hard to find good deals, right? To find the kind of deals you want. But I do think end of 2019, early 2020, that you might start seeing more good deals, and you might start seeing people wanting to get rid of their properties. And so I believe there will be more opportunity. But right now, I think we're just kind of in a flattening period.
Yeah, and I think that's exactly what was interesting about our call, or what I wanted to have be brought out here is that, with looking for trends, with looking for predictions and stuff, and all this stuff is just predictions. No one has a crystal ball. No one knows exactly what anything's going to happen. But if we can see that interest rates are being risen, and like you said, the dollar is not buying you as much as you could before, prices will adjust with that. And if it flattens out, then what does that mean for us? And that means there's potentially going to be more opportunity for people, because it has been the last year to 2 years has been challenging to find good deals. They're still there, and you can still find them, and you can still invest in real estate, but it is more challenging. If it was easy, everyone would be doing it. So with that challenge being there, I think that challenge is going to then be a little bit eased up. It's going to be a little bit easier to find deals, as the media is our best friend. When the media says, "Oh my gosh, real estate's in the tank," well, everyone thinks that. Well, then that's the best time to buy.
That's exactly right. I mean, look, if the word gets out that real estate's going bad, that's opportunity for people that understand the real estate market, right? The opportunity is not when things are good. It's when things start going down, that's where the opportunity presents itself. And so, one of the things I think is really going to be interesting is, listen, when the market crashed 2008, 2009, obviously there was people out there buying and flipping homes and, in the real estate investment business. But I think 2010, 2011, 2012, a boom started of people deciding, I don't want to be in the stock market. I want to figure out how to buy real estate. And there was tons of deals out there, and there was tons of people getting into the business, and really interesting, exciting time in the real estate investment business. But I'm fascinated to see, as things flatten out a little bit, are people kind of go away a little bit and really let the more, I don't know what the right word is, determined or person that really believes in real estate, it's not just a fad for them, that I think that will create more opportunity for them, because there'll be fewer people just sticking their toe and wanting to try it. Oh, it didn't work, and move on. I don't know what you see, but I'm fascinated to see what happens, because I definitely think there was a huge boom in this business, 2010, 2011. I mean, I know I got in 2008, and, I have a lot more people interested in buying real estate now than I did, when we first started.
Well, there's always going to be people. In fact, actually, at one of our bus tours, the last bus tour of last year, one of the gentlemen that we were showcasing one of his renovations down in Soulard, who works with your company a lot, said that he counts on people to fail. His business depends on other people failing. And it actually had a pretty big impact on a lot of people on the bus, because they're like, wow, that's interesting. And he wasn't a piranha or any, shark investor, but he's just like, look, people are going to always want to be interested in real estate. It's a fascinating industry. There's tremendous fortunes to be made. There's just great wealth to be generated, great income to have. It's a sexy business. You're taking an ugly product and turning it nice and selling it and making money. There's the cash flow. There's a lot of lures, a lot of attraction to this industry. And when the good times are really good, a lot of people are more turned on to it because it feels safer. People want that safe, warm and fuzzy feeling like, oh, it's going to be a good time to invest in real estate. When in all actuality, the best time to invest is when markets are in the tank, or when the media is on our side saying, oh, the run for the hills, it's shadow inventory and millions of homes and banks foreclosing and all that kind of stuff. That's when the smart people should be buying up everything that they can possibly afford. But in reality, the masses are running for the hills. So yeah, it will be interesting to see what is going to happen as it flatlines out. I don't know. I mean,
and Nick, just to follow up on that point, I think you made a really good point. You said, the smart people, when the media and the world is saying that real estate's terrible, things are tanking, millions of foreclosures, everything's bad, we can just go back to our short little history, right? 2009, 2010, when that started happening, like you said, the smart people start buying. And look, let's be honest, the smart guys are the guys with the money, right? So the guys up on Wall Street, the guys in the investment banks. And what did those companies do during the worst downturn that we've ever seen in our lifetime? Those guys, there was multiple hedge funds that went out and bought tens of thousands of single-family homes. And this is something they'd never really done before, right? They'd always done multifamily because they thought multiple doors in one place a lot easier to manage than houses. Yeah, but they all saw that this was an unbelievable opportunity, and they literally bought tens of thousands of single-family homes and created giant rental portfolios. And a lot of those funds, now a lot of them got out and sold, but a lot of those funds are still buying today. And so, I think when you want to say follow the smart money, follow the smart guys, those guys bought single-family homes when things went down, and I promise you that if it goes down again, they're going to be jumping back in the water, especially the ones that got out. So, look, it's opportunity, right? And that's why I think, it's funny. I was talking to one of my borrowers the other day, and we've done a couple deals together and up in Indiana, and he told me he wanted to do a whole lot more properties, and I just said to him, I think that's a great idea, but I think you're going to have a hard time finding those deals right now. But I said, if you wait 6 to 12 months, I think you're going to be finding a lot more opportunity at probably at better prices.
Okay, so I absolutely can agree with that, but at the same time, I don't think that means quit. This is where I might disagree with you, because there's still good deals out there, and you can find them, and you can invest in real estate and make money in today's market. Because I get that question a lot. Did I miss the boat? Right?
No.
Did I miss out?
And look, I'm not saying, just, I'm not saying don't do deals. No, I'm not saying that at all. But like what you said, I think to find good deals, you got to work a little harder, right? You got to be a little more, you got to be more creative in finding your deals. There's deals to be had, but they're not just laying out there where anyone can just go pick them up. You've got to hustle. You got to find it. You got to find a mentor. You got to find someone. Okay, how do we find these good deals? You can't just go out on the MLS and think you're going to find a great deal.
No, absolutely. And then, we always say the closer you get to the homeowner, the better the deal becomes, because that's really the case. If you can go out and find motivated sellers and have a whole system to do that, and that's not really the point of today's call, but there are ways and there are channels to find good deals. And can you buy something off the MLS and make money? Absolutely. The challenge is, as for all the other people that are fishing right now, that's low-hanging fruit. And so the reality of it is you're going to buy 1 or 2 properties a year if that's your only strategy. But getting back to is it a buy signals or sell signals? And I think in general, obviously it depends on what strategy, if you're building up a rental portfolio, if you're just doing flips, or if you're doing wholesaling. But I mean, there's buyers out there. It's safe to invest now because whereas in 2010 you had to hold on to it for a little bit longer. It's definitely a lot safer now, but the margins are a lot thinner. Okay.
That's exactly right. That's exactly right.
The margins are a lot thinner. You're paying more for the property. You're paying more for the labor to fix it up. And you're, up until about a year and a half ago, you were able to compensate by asking more for your pricing, what you're asking for the property. And as we're seeing this now in certain areas in St. Louis, it's kind of leveled off already in the higher price ranges, and just certain areas in town. But there's still a tremendous amount of opportunity to still make a spread. It's just a smaller spread that you're making, and you can do those deals to get to make a great living and build wealth and do all the fun stuff that real estate allows you to do. I just think that the deals are going to become better as it really starts to flatten out. Now let's talk about a little bit more, because I don't want to take up too much of your time. But let's talk a little bit more about the St. Louis here in general. I know you're from Dallas, but you have borrowers in 5 states. Are you seeing St. Louis exceeding or are you pricing expectations, or are other states slowing down faster than we are? Where are we at compared with the other 5 states that you work in?
So I think St. Louis, certain cities that we are in had much more of an explosion than St. Louis. I think St. Louis is much more steady growth, or steady increase in prices than, like, let's say, Austin, the prices kind of just went up exponentially. Dallas, they've had tremendous increase. Nashville, tremendous increase. But when I'm in Charlotte's, a tremendous increase. But some of the other cities I'm in, Indianapolis, Chattanooga, Houston, I have not seen, they've been a little more steady. The recovery from them, they went up and they've all kind of stayed, kind of flattened out a little bit. St. Louis kind of falls into that. It went up, it recovered. Then it's we had a little rise, and then it's kind of flattening out for us right now from an actual price standpoint and selling of properties for our borrowers' standpoint. But I just want to touch on one of the things that I think you mentioned earlier that I think makes a lot of sense for people is when you get in the real estate business, right, it's what is your expectation, right? So like you said, if you create the expectation you want to come in and there's still good deals to had, but you're just not going to make as much, right? You're going to make a little money, but you're not going to make these giant windfalls, right? Or, you got to have an expectation. Hey, if you're going to flip a house, you make 15, 20 grand, you did great. But if you're looking to make 100 grand, those deals are much more difficult to find right now. So as long as your expectation, I think, is reasonable, I think you can be successful, right? So St. Louis right now, what we're seeing is there's a lot of good deals to be had for rental units, right? There's lots of properties out there that are reasonably priced, right? You can buy them 60, 70 grand, put 20, 30,000 and fix them up, 2 to 4 doors, and you can rent those suckers. And that's nice cash flow on the deal, right? People refinance out of my loan. They get a longer term longer term loan, lower interest rates, and they cash flow those things. And that is a great way to build wealth in real estate, right? Because your equity is going up on the property, you're creating cash flow, you're paying down your debt based on the rent that you're collecting, and that's a great business model to build nice, steady wealth over time.
Absolutely. And what's nice about that is if you have a way to identify those properties and consistently identify those properties and find those properties, and you can add 4, 5, 6 of those a year, you can have a full-time job, hire a property manager, and crank out 1 a quarter on those. Over the course of 5 years, you built up a tremendous amount of equity and a tremendous amount of cash flow that would blow the pants off of any other 401k that saving just a couple $100 a month in a 401k program.
No question. And listen, now is a great time to get into that business because there are more people. Let's say, you use me or somebody else to a hard money loan, you get into the property, you buy it, you fix it up, you get it rented. You have so many more avenues now than just 5 years ago of people that will refinance you out of that loan. Mm-hmm. And you can get refinanced out. Look, your local bank's doing it. Your credit unions are doing it. There's, the big boy banks, the national banks are doing it. There are private equity hedge funds that are doing it now. Everyone is out there, has their own program to get you refinanced out for the rental property. And these programs were not there 5 years ago. So it is a great time if you can go identify the property, understand, but you got to understand, hey, what's the rehab going to cost? How much rent am I going to get? What are the taxes going to be? What are the insurance going to be? Run those numbers. Make sure your numbers make sense, right? Make sure they work. Understand what your refinance is going to cost you, and you can get your deals done, and you can get them done relatively quickly because there are so many lenders out there that are doing this right now. Great time to be looking for rental properties.
Absolutely. And then we're just going to get better deals as it kind of flattens out a little bit. Now you also mentioned, and getting back to St. Louis, that certain price ranges are always going to be good. That first-time homeowner market, obviously,
yes,
is going to be good. And when we say like maybe leveling out, do you anticipate like longer days on market to get these things sold, or just the prices are going to start to flatline out, or
both? I mean, look, when I say flattening out, all those things you said are going to come true, right? You're going to have to ask for a little bit less. You're going to take a little longer to find the right borrower. I mean, all these things, when I say the price is flattening out, the market's flattening, all those things are going to be taking place, and we're all going to see it. Now, look, everything is relative, right? You got a great location on a property, a great school district, whatever it may be, it might go like hotcakes. But I'm talking overall, the market in general, that is what I anticipate is going to be happening, is that you're going to be houses on the market longer, and you're going to have to ask for less money. You're going to have to drop your prices. That is going to happen. Now, I'm not saying it's going to be a huge drop. I don't foresee that happening anytime soon, but it's going to happen. And we're already seeing it happening. Look, in certain price points, it's already happening, right? Mm-hmm. But me personally, I love the first-time home buyer market. I think that is the absolute safest place to be as a real estate investor.
I 1,000%
simply
agree.
because there are more people that are eligible to buy those homes or rent those homes than any other price point in this country, without a doubt. And the federal government gives the best programs for those deals, right? 2.5% or 3.5% down. Some you can get 100% financing. You can't find that on the $600,000 home, on a $500,000 home. But you're $200,000 and less, you can find those deals. So I love that price point. I love playing in that price point.
I absolutely agree. I think that is the safest place to play. And if that market is doing well as well, the secondary market, the move-up position homes are going to move as well. But when you start getting up into that higher price point, 500,000, 600,000, 700,000, it definitely, you can make money in that price range, but I would not start out there.
No. You got to be, you got to be careful on that, especially, look, on a $100,000 or $150,000 home, interest rate goes up, it matters, right? There's no doubt about it matters. But you're talking a $500,000 home and you're doing your interest rate goes up, ticks up a point, a half point. that's real money, and that's when people got to make real hard decisions. Hey, do we really want to do this, man? Our dollar's just not stretching as far, and it doesn't make sense. And so they end up not going to that price point home. And if you are a real estate investor and you want to flip homes and you want to play in that $500,000 to $700,000 range, you better make sure you got the capital to be able to stay holding that property, right? Because your holding costs are going to be a lot more expensive, obviously, on the bigger property, and it's harder to find that buyer, right? They might look sexier because you might go, well, the spreads are better, man. I bought this thing for 400. I'm putting 100,000 into it. I'm going to sell it for 650. I'm going to make all this money. But do your homework, do your math, make sure you understand your carrying costs, and understand that it's harder to find that buyer for that price point, man. Instead of the $150,000 price point, you got tons of buyers.
And the thing is about that higher price that you got to watch out for, the higher price point homes, you have one exit strategy.
That's right.
And that's to sell it to a buyer. And if it takes 6 months to find that buyer, oh my gosh, I don't care who you are, you're gonna have some sleepless nights, right? Like, what am I gonna do? Like, you can't rent this thing out. I mean, you can, but you're gonna lose money. So yeah, it's you got to watch out for that. Can it be done? Yes. Can be successful? Yes. But my gosh, I would strongly suggest doing a lot of properties and getting your feet with not just jumping out in with both feet and starting with a price in that price.
And Nick, you know better than most, though, that the other issue with that is not only it's going to take longer and you only have one exit strategy. Typically, your rehab is going to be a little more expensive than you think because you're trying to sell a $650,000 home. You better do a real nice rehab.
You better do a pretty damn good job for sure.
Yeah, it's a whole. Yeah, I think trying to speculate in that market is not for the faint of heart, right? That is a much more challenging market. And look, like I said, I've been doing this 10 years, and I rarely do a loan that big or that size on that type of property, just because I think there's too much risk for that. For me, it's got to be the right market, the right neighborhood, the right home. You really got to do your homework if you want to jump in on one of those properties. Like you said, not saying that it can't be done, just a lot more risk. Just a lot more risk on those.
Cool. Well, hey, before we go, I want to showcase. I'm going to switch gears here just for a second and get over to our Wallace Shame segment here. And if you're watching on YouTube, you'll be able to see this. If you're listening on our podcast, you probably won't. But this guy right here is and by the way, we can't see Michael because he's still in 1980 and does not own a webcam or any type of camera equipment. So I'm going to just try to find a Facebook photo of you and just put you up here, I guess. But this is our Wallace Shame segment, and this was got out of a house. And our Wallace Shame segment is whenever we buy a house, we like to take at least one item from that property to remind us, take it as a memento, and remind us that we got it from that house. And it's got to be something obscure, weird that we wouldn't buy that you couldn't find anywhere else, basically. And this particular thing, I guarantee you. Let me try to get this in frame. I guarantee you're not going to find this anywhere else, anywhere in the country. This is priceless. This is a wood slab that has some varnish on it and some sort of iron spike. It's built really well. And someone fashioned this into a little mannequin and spray painted it black, or maybe it was always black or whatever, welding some arms and some legs on and some feet. And I think this is a wooden hat. No, it's all metal. And then put a nice fishing pole on it with some copper wire on it to make it look like a gentleman is fishing. And it is ugly, it is bizarre, but I love it, and it's on our Wall of Shame. You're not going to see anything like this ever out there. This is one of a kind, and it's priceless. So
Nick, I want to understand. So you bought the house, and you found that in the house. The homeowner just left it there.
Yeah, I don't know why they wouldn't want it.
I mean, it sounds like they put a lot of work into this thing. I'm surprised they just walked out on it.
This is hours and hours of work. You don't just slap something like this together. I mean,
dude, maybe it'll be up on your YouTube channel, and you can find the guy, and maybe they want to buy it back from you.
I don't know if I would. I mean, maybe if it was his grandmother's something.
You wouldn't sell it. That could be a family heirloom. Could be a family heirloom in there.
how can you put a value on this though? I don't understand. So, and anyway, this you'll probably see this in the background here sometime. This sits behind my desk, and I cherish it, and I wax it, and I dust it, and I take care of it. It is one of my prized possessions. So this is a great addition to the Wall of Shame. And to be honest, I cannot remember which house that this came out of.
No.
I know. We need to start labeling these things. But I cannot remember which house it came out of. All I know that we picked it up sometime last year. And
I think you should have kept that quiet. I think you should just assigned you the house and decided this is the house we got it out of. Because now how's it going to remind you of the house? You don't know which house you got it out of. I
know. That's the whole point of the Wall of Shame and the mementos. I think I do know which house it was. But I need to check, and maybe I'll just put that in the show notes or link description or something. I'll have to check and see exactly which house it is. But yeah, that's the Wall of Shame segment. So, any parting words, Michael?
Happy New Year. Hope everyone had a great New Year's. And I think this is going to be the next 12 to 18 months are going to be a very, very interesting time in real estate. So listen, now's the time. Get educated, figure everything out, learn what you got to do, because it's going to be buying time soon.
Awesome. Hey, man, thanks for your time. I really appreciate taking the time out to chat with us for a little bit about insights. And again, this is a general kind of thing that we're talking here. It's not run for the hills kind of thing. I think the biggest thing to take away from this is opportunity is just around the corner. And while we can still make money, if we keep our expectations in check, we can still make money. We haven't missed the boat. We can still buy properties at discounts and fix them up and sell them and rent them out. And there's still awesome opportunity out there. But I think more opportunity is coming down the pike that's going to ease it up and make it a little bit less challenging to find good deals. There's going to be a little bit more of them out there. We'll be paying a little bit less for them and maybe selling a little bit less, but there still will be a spread. And as long as we know the numbers and understand the market and watch for those things, we'll be able to do that. And I want to make sure that if you're listening, that people understand these are general statements. This is not like, oh, what Michael says is gold and it's going to happen. And if it doesn't happen, we're going to all run the village and take pitchforks and burn down his house and all that kind of stuff. Because actually, I had a couple of years ago, I was talking about how we were back at 06 pricing and in some places a little bit beyond, meaning the price of a house in 2006, went down, and then 2011 started to come back up, and we were at 2006 pricing again, and it was great. And I was just proclaiming that, saying this is a wonderful thing because we haven't been at this pricing level in a long time. And some lady contacted me, livid. My house is worth way more than it was in 2006. And I said, okay, lady, I'm sure it is.
Yes. Our legal disclaimer, every deal is different, right? Yep. We are talking in generalities. This is not specific to your particular property or a particular deal that you're looking at.
Good disclaimer. Spoken like a true attorney.
There you go.
But no, hey, seriously, thanks for your time. I really appreciate it.
No, thanks for having me.
And
thanks for having me. I really appreciate being on.
No, absolutely, man. And maybe we'll have you on towards the end of 2019 and see if your predictions came true.
Yeah, I'd love to do it.
Hey, man, Happy New Year. Have a great
you too.
Rest of the day. And folks, thanks for tuning in to our second installment, volume number 2 of the REI RockStar podcast with Michael Hoffman from Longhorn Investments. I've been your host, Nick. Signing off here. As always, we'll see you at the top or from the top. Talk to you soon.